This is episode 262 of Zen and the Art of Real Estate Investing with my guest, Neal Bawa. Neal is the founder and CEO of Grocapitus. He's also known as the mad scientist of multifamily. He's one of the most in-demand speakers in commercial real estate, a data guru, process freak, and an outsourcing expert. He treats his $660 million, it's probably more by now because I'm always reading these bios from the site, multifamily portfolio as an ongoing experiment in efficiency and optimization. Neal, welcome to the show.
Thanks for having me on, Jonathan. It's great to be on the show. Look forward to the chat.
Yeah, me too. I'm excited to talk to you, especially since you're a mad scientist and multifamily's had an interesting run over the past few years. But I know you didn't start in real estate. What was the thing that led you to real estate?
I fell into real estate. So I'm a technologist, computer science degree, data science is my background. I was running a tech company with 400 employees in Silicon Valley. We were doing well. We were making a lot of money. You know, I had the big fat tech salary. I live in California. So, 40, 50% a year in taxes. And, our CEO decided to build a campus from scratch in 2003. This was, no investors, no loans, just, cash. And by the time we built the campus, I had a tiny little slice of it. And I noticed that my taxable income had gone down a great deal. So I learned about depreciation. And so, we ended up building 5 or 6 or 7 campuses. And over time, my income was going up because the company was doing better and better. We were making more money and my taxable income was going down. And I was like, this depreciation thing has got to be America's best authorized tax scam. But it seems like it's been going on for more than 100 years. So I think that the law is pretty good. The IRS code is pretty good. And so by the time I had a significant amount of money, millions of dollars in the bank, it was 2009. So my timing was incredibly good. I started a meetup group, started to write real estate algorithms using, code and a software called R, and started to publish it, started to buy dozens of single family homes. And that is what got me going, not as a syndicator, not as somebody who took other people's money, but as a real estate investor. That's what got me into real estate.
I think the most important part for me on top of the data is that you immediately went and looked yourself, because technology is so great, obviously from being in the tech world and being data scientists, but people can get too excited about the tech and forget to go look at it and make a lot of mistakes. Now you took all the data and you added that extra layer because one thing that was really interesting that you said is like you had the program and then you guys all said, oh, wait, we need a place. Because if not, you would have done all that work and then ruined it by just dart throwing a place. It ruins all of the work. But by going and seeing it, talking to the broker, and then going and making that educated guess and smart tech decision to run it on the older place in Fresno, that was the boots on the ground that I think some newer people are missing when they may listen to you and think, oh, well, that sounds easy. It wasn't as easy. It was a lot of work.
Yeah, and most importantly, I have to say this, right? So now I have 1,300 investors. They've given me $425 million of their money to buy $1 billion worth of assets or to build $1 billion worth of assets. And I can tell you this, in all of those years of learning and paying for millions of dollars of software, I have not yet found a way to reduce the necessity of boots on the ground.
Oh, amazing. I'm so glad you said that. Yeah, because
what data does, it tells you where to put the boots.
Yeah, exactly.
But it doesn't in any way reduce the need for the boots. Because maybe one day that'll happen with real estate, but I have not found anyone, any peer of mine, I've presented at over 100 conferences, and I have not yet found somebody who's done this for years and says something like, well, my model doesn't require boots on the ground. No one has ever said that.
If you're a LP investor and you're looking to invest into multifamily starting now, deals that are coming up to start, do you think it's more a better idea for them to look for build projects that are going to take longer, or for some projects that will deliver and you can see the rent growth going up in the next year?
Everyone has a different thesis. Yeah. So I'll tell you, I am very blessed to have certain investors that are billionaires, right? These investors have bought into my thesis. And my thesis is very different from what you would hear on this podcast. So what you'd hear from this podcast is this is a great time to buy multifamily. Prices are down 20%. I'll say it's a pretty decent time to buy multifamily, definitely better than anyone that bought in 2021, 22, 23, or 24, right? So 25 beats the crap out of those 4 years. Is it a great time to buy? I'm not so sure, right? Because interest rates are still high and you
Yeah.
pretty much have to get a fixed loan, which means that once you fix your loan, you basically have lost the ability to refinance for 5 years. That isn't the case in single family. So we lose the ability to refinance for at least 3 years.
Yeah.
Now, there's another thesis, and this, I call this the great mispricing. I actually have a very elaborate PDF that goes dozens of pages and pulls dozens of CoStar reports to prove the great mispricing. For the first and possibly the only time in US history, in 2024, the average price per door of Class A properties was lower than Class B by $8,000. So Class B properties around 245 and 245K per door seems a high price for Class B, but keep in
Yeah.
mind the gateway metros like Boston, you're selling for
Right.
four, five, $600,000
Yeah.
a door, so that's affecting the price. Um, Class A sold for 237, $8,000 less. This should never happen because you have a property that's 40 years old
Yeah.
that is selling for more than a property that's 40 months old or 40 weeks old, right? So it's shocking that this would happen. The only scenario in which this is possible, the only scenario, there's only one edge case scenario where a Class A property can sell for less than a Class B nationwide. And that scenario happened in 2024. And the scenario was that the properties that were just coming into the market, there was so much supply
Yeah.
that those properties all had 2 months of concessions. Now, if your property's rents are $2,000 and you have 2 months free, then your effective rent is only $1,600. Now, there's a Class B property down the road that's at $1,650, but it's not offering any concessions. So what you had to do to lease up your property to beat that Class B property was to basically offer a price lower than a Class B. And so you offered a $1,600 price. It worked. You leased up your property. You hit 90%. You're desperate now because you've been paying an 11%, 12% construction loan. You thought it was going to be 6, but it really turned out to be,
Yeah.
11 or 12. You're out of money. You need to sell your property. So you sell your property at 90% because that's 90% is the point where you'll get the highest possible value. But here's the problem. Remember those 2 months of concessions? They showed up on your rent roll. And
Yeah.
because they showed up on your rent roll, anybody that's buying this property is giving you $1,600 of rent value for your property when they're paying for it, not $2,000. And as a result,
Yeah. It's
in
crazy.
any market that has a very large amount of supply coming in, you have Class A properties selling cheaper than Class B. I don't think that opportunity will ever come again. I call it
Yeah.
the great mispricing. In 12 months, it will completely disappear. I've just received a $100 million check from a single investor who believes in the great mispricing.
The townhomes just make sense. You're saving on the amount of walls because you have the shared wall for all of the row of units that get down there. And plus, you have the designs, as you said. And I think you're using data, obviously, with your background the right way to make quick decisions. Hey, here's our plan. City says, no, great, move on to another one. And that could be the city's loss. That property could sit there for a long time. Same as those owners who you're offering the equity stake. They don't take it, somebody else takes it, and in 5 years they're closing out, doubling their money, and the other person's land may still be sitting there.
What's really compelling is because of the land crash that I haven't seen a single article on land prices in the US for multifamily crashing, right? No one's written one. Maybe I should write one. The truth is that today I'm controlling more than $80 million worth of land with deposits that are roughly 2% of that amount. So with $1.6 million in deposits, I'm controlling $80 million of land. All of my contracts are 21 months long. So I have a year, 6 months to do my due diligence. I
Yeah.
have 12 months to do my government approvals, entitlement, zoning, permitting. And then I have extensions that take me up to 21 months. If in 2022, I had offered this to anyone, they would laugh at me or cuss at me. But today we offer it, 90% of the people still laugh at us and cuss at us. But we go through 7,000 parcels of land. We underwrite about 700. We make about 100 offers a year, and 10 of them get accepted. So we currently have 10 projects in contract, and we'll probably flip 3 or 4 of them. So we'll buy them for $1 million. We'll spend maybe 500,000. We'll flip them for $4 million to other developers that are not as patient as us.
Right.
And then
They
the
want to
rest of
walk
them will
into
build.
fully
The rest of
like
them will
ready to go.
build.
Yeah.
Exactly. So I think that strategy, unfortunately, this strategy that I've just mentioned is time sensitive. It works today and probably will work for the next 12 months. And then will stop working because the land people, as soon as they realize that it's a seller's market, it'll stop working. Today,
Yeah.
it's a buyer's market with land. And so I can create all these kinds of absurd terms and still get enough pieces of land to run an incredible business.